I need you to pay close attention because what I'm about to reveal could devastate your investment portfolio and financial security if you don't act quickly. A banking crisis is quietly building beneath the surface of the financial system, and when it hits, millions of investors could be blindsided. I've been analyzing and investing in banks for over 70 years. I bought my first bank stock in the 1960s, lived through the savings and loan crisis of the 1980s, and navigated the 2008 financial collapse. I know how banks make money, how they fail, and how catastrophic it can be for shareholders. Let me be clear. The largest banks, JP Morgan, Bank of America, and similar institutions are well prepared. They have massive capital cushions, diversified loan portfolios, and advanced risk management systems. My concern is not them. My worry is smaller regional banks sitting on a dangerous mix of bad loans, concentrated deposits, and management that is unprepared for a crisis. These banks are ticking time bombs, and when they fail, shareholders will lose everything. Take Silicon Valley Bank as a warning. In March 2023, it was the 16th largest bank in the U.S., with over $200 billion in assets. On Wednesday, it seemed fine. By Thursday, panic erupted. Within 48 hours, the bank collapsed. The problem? SVB had taken low-interest deposits from tech companies and invested them in long-term bonds purchased when rates were near zero. As the Federal Reserve raised rates, those bonds lost massive value. When depositors began withdrawing funds, the bank was forced to sell bonds at a loss, destroying its capital and triggering a classic bank run. SVB's fate is not unique. Dozens of other banks are exposed to the same vulnerabilities. The first category of banks to avoid: regional banks heavily exposed to commercial real estate. Millions of investors still hold these stocks, wrongly assuming the problems will resolve themselves. They won't. Office vacancies in major cities are at record highs: San Francisco, New York, Chicago, Houston, Los Angeles, all experiencing permanent structural declines due to hybrid and remote work. Companies no longer need as much office space, and rents are collapsing. Regional banks finance these loans, often making up 30 to 50% of their portfolios. Now, as property owners default, banks are facing mounting losses. Here's how a bank fails in this scenario. Imagine a regional bank with $10 billion in assets and $1 billion in equity, a 10% capital ratio. If 30% of their loans are in commercial real estate and 20% of those default, recovering only half, that's a $300 million loss. Capital drops to $700 million, and a ratio falls from 10% to 7%. Depositors notice the losses and pull their money, forcing the bank to sell assets at a loss, further eroding capital. A death spiral begins. Warning signs to identify at-risk banks. Loan portfolio composition. More than 20% in commercial real estate is a red flag. Over 30% is extremely dangerous. Type of properties. Office and retail loans are most risky. Industrial and multifamily less so, but still vulnerable. Geographic exposure. Banks concentrated in cities with high vacancies like San Francisco and New York are most exposed. Capital ratios. Tangible common equity below 8% is concerning. Below 6% indicates serious risk. Deposit base. High levels of uninsured deposits increase vulnerability to runs. Deposit trends. Declining or unstable deposits signal eroding confidence. For example, a California regional bank with over 40% exposure to San Francisco office buildings has already seen its capital ratio drop from 9.5% to 7.2%, deposits down 15%, and stock down 60% from its peak, with further declines expected. Another Texas bank exposed to Houston and Dallas offices faces similar losses. Investors need to act now. Waiting is not an option. Commercial real estate lending is inherently risky. Banks lend up to 70 to 75% of property value, with borrowers contributing the rest. This equity cushion is supposed to protect banks, but collapsing property values and strategic defaults are eroding that safety net. Property owners often choose to walk away rather than throw good money after bad, leaving banks with undervalued, half-empty buildings and mounting losses. The combination of falling property values, rising interest rates, and concentrated deposits creates a perfect storm. Depositors lose confidence, withdrawals accelerate, banks sell assets at losses, capital evaporates, and the failure cascade begins. These are not hypothetical scenarios. They are unfolding now across regional banks in the U.S. Investors must be proactive, analyze loan portfolios, capital ratios, geographic exposure, deposit types, and trends. Diversification, caution, and vigilance are critical. Selling high-risk bank stocks now can prevent complete financial devastation. The regional banking crisis is accelerating, and the commercial real estate collapse is just beginning. Waiting for the market to correct itself is a dangerous gamble. You must act before it's too late. The warning is clear. Regional banks with heavy commercial real estate exposure are the first dominoes in a banking crisis that could rival 2008. Study their filings, monitor their capital, deposits, and loan structures, and exit positions that show multiple danger signs. The collapse will be swift, ruthless, and unforgiving. Protect your investments while you still can. Property values haven't just fallen slightly, they've plunged 40, 50, even 60% or more from peak levels. In many cases, borrowers' equity has been completely wiped out, leaving the bank underwater on the loan. The loan amount now exceeds the property value. When there's no equity left, borrowers have every incentive to walk away. Rental income has collapsed alongside property values. A building that once generated $10 million annually may now bring in just $5 or $6 million due to high vacancies and declining rents. Even if borrowers wanted to continue payments, they often cannot. Rental income no longer covers debt service, operating expenses, property taxes, or maintenance. These buildings become money pits. Rational business owners, developers I've spoken with, are walking away, handing the keys to the bank and moving on. Multiply this across hundreds or thousands of properties and dozens of banks, and the scale of the crisis becomes staggering. We are looking at hundreds of billions of dollars in commercial real estate loans heading toward default in the next few years. Banks will face massive losses. Some will survive, many will not. This situation is further amplified by a cascade effect. When one property defaults, it depresses values in the surrounding area. A major San Francisco office building selling for 50 cents on the dollar establishes a new benchmark. Other borrowers and lenders see the writing on the wall. Their properties are worth far less than expected, triggering more defaults, more foreclosures, and a negative feedback loop that intensifies with each wave. Commercial real estate crashes never happen all at once. They happen in waves, each one amplifying the next. We're currently in the early stages. The first wave is beginning, the second will be larger, and the third could be catastrophic. By the time the cycle bottoms out, property values may fall far further than most imagine. Another factor worsening this crisis is the lack of buyers. In past downturns, opportunistic investors snapped up distressed properties. Today, the shift to remote work makes office valuations highly uncertain. Investors, even seasoned real estate private equity firms that prospered in 2008, are reluctant to buy, seeing no clear path to profitability. Without buyers, foreclosures sit empty, deteriorate, and losses accumulate. Regional banks with heavy commercial real estate exposure also face increasing regulatory pressure. Bank regulators are forcing institutions to recognize losses, build capital, and submit to detailed portfolio examinations. Some banks try to delay reckoning by extending loan terms or capitalizing interest, creating the illusion of solvency. Regulators are cracking down, insisting banks confront reality. When losses are fully recognized, many banks will find themselves insolvent or near it. Capital will vanish, and raising new equity in a declining market is nearly impossible. These banks will fail or be forced into distress mergers, wiping out shareholders. This is not the time to buy value or be a hero. The first category of at-risk banks, regional banks with heavy commercial real estate exposure, will see multiple failures over the next 12 to 24 months. Some will be acquired at fire sale prices. Others will be taken over by the FDIC. Equity holders will lose nearly everything. The second category is banks with concentrated deposit bases, particularly those dependent on a single industry or customer type. This risk is subtle but deadly. Banks operate on a fractional reserve system, keeping only a fraction of deposits on hand while lending the rest. This works until many depositors attempt withdrawals simultaneously. Today, digital banking accelerates bank runs. Millions can be withdrawn in hours. Silicon Valley Bank is a cautionary tale. Deposits concentrated in tech startups and venture capital firms vanished almost overnight, triggering the bank's collapse. Other banks with concentrated deposits face similar risk. Crypto banks rely on exchanges, miners, and investors. Another major crash or scandal could trigger mass withdrawals. Cannabis banks serve federally restricted businesses, creating concentration and cash risk. Entertainment banks cater to production companies, talent agencies, and actors. Strikes or industry downturns could create sudden withdrawals. Private banks hold wealthy clients with large uninsured deposits. Sophisticated clients notice risk and move funds immediately. The fundamental danger is correlation. Deposits that are normally uncorrelated become highly correlated within a single industry. A negative event triggers simultaneous withdrawals, and the bank cannot meet demands. Identifying risky banks requires diligence. Examine marketing materials, branch locations, customer focus, deposit size distribution, and stability. High uninsured deposits or volatile deposits indicate concentration. If you spot a highly concentrated deposit base, sell immediately. The downside is catastrophic. The upside is limited. These banks can fail in hours. Waiting until the crisis is visible is too late. History reinforces the risk. During the Great Depression, many banks failed due to concentration: farms, factories, mines. When a sector collapsed, deposits vanished. FDIC insurance was created to mitigate these risks, but it only protects small retail depositors under $250,000, not commercial or wealthy clients. In conclusion, regional banks with heavy commercial real estate exposure and banks with concentrated deposits represent extreme risk. The combination of collapsing property values, rental shortfalls, cascading defaults, regulatory pressure, and correlated withdrawals makes them highly vulnerable. Acting proactively is critical. Exit positions now, preserve your capital, and avoid being caught in the next wave of banking failures. Large commercial depositors with balances far exceeding FDIC insurance limits face significant risk. They know their money isn't fully protected, so they monitor bank safety closely and will withdraw funds at the first sign of trouble. This is exactly what happened with Silicon Valley Bank. Most of SVB's depositors were businesses with large uninsured balances. When rumors of trouble emerged, these sophisticated depositors acted immediately. Within hours, tens of billions of dollars had exited the bank. SVB could not survive the speed and magnitude of the outflow. Other banks with concentrated deposit bases face the same vulnerability. Banks serving the crypto industry, cannabis companies, the entertainment sector, or wealthy families are all at risk. If depositors are spooked, money can vanish in hours. Once a run begins, it becomes self-reinforcing. Even depositors who were initially unconcerned rush to withdraw, accelerating the bank's collapse. Crypto-focused banks are particularly dangerous. The cryptocurrency industry is volatile and speculative, with extreme price swings, bankruptcies, scandals, and regulatory uncertainty. When a crypto crash or scandal occurs, crypto businesses need immediate access to deposits for margin calls, customer withdrawals, or liquidity needs. Banks serving primarily crypto clients face simultaneous asset deterioration and deposit flight, a death spiral scenario. The upside is modest, the downside catastrophic. I would avoid crypto-focused banks entirely. Cannabis-focused banks face unique regulatory and legal risks. Cannabis remains federally illegal, exposing banks to potential regulatory crackdowns or money laundering investigations. These tail risks are low probability but extremely high impact. If realized, the bank could be shut down overnight, wiping out shareholders. Another category of risky banks relies heavily on brokered deposits, funds sourced through deposit brokers who constantly shop for the highest rates. Brokered deposits are highly volatile. If the bank lowers its rate or becomes perceived as risky, the money disappears instantly. Banks depending on brokered deposits compete constantly on price, squeezing margins and creating structural instability. In crises, brokered deposits flee first, often triggering a death spiral. Historical precedent during the 1980s savings and loan crisis demonstrates how banks relying on brokered deposits failed catastrophically. The third critical category is banks with weak management and governance. Even strong balance sheets cannot compensate for poor leadership. Good management navigates crises, while bad management can destroy a bank. I evaluate management using 5 criteria: experience, conservatism, incentive alignment, board quality, and capital management. Experience matters. Managers who have survived a credit cycle or recession understand risk and respond rationally under pressure. Inexperienced leaders often make fatal mistakes during downturns, having only known easy money and rising markets. Conservatism is key. The best bankers say no more often than yes, focus on credit quality, capital ratios, and risk management. Aggressive growth-chasing managers tend to ignore underlying risks. Alignment of incentives is crucial. Compensation based on short-term growth encourages risk-taking. Incentives tied to long-term capital preservation encourage prudent decision-making. Stock ownership matters. Managers with personal capital at risk act more cautiously than those relying on salary or bonuses. A strong, independent board is equally essential. Boards that challenge management, understand banking risks, and maintain oversight prevent poor decisions from accumulating into catastrophic problems. Weak boards allow errors to compound until crises emerge. Capital management decisions reveal management quality. Banks that preserved capital during boom periods are better positioned to absorb losses, whereas banks that prioritized buybacks or dividends are now struggling as losses mount. Decisions made years ago often determine whether a bank survives a crisis. Transparency is another hallmark of strong management. Good leaders disclose problems early, communicate clearly with shareholders, and respond forthrightly to challenges. Poor management hides issues, delays loss recognition, and gives evasive answers. Transparency during good times is especially telling. Disciplined managers prepare for downturns, while aggressive growth chasers set themselves up for failure. I look at quarterly earnings calls, annual proxy statements, executive compensation, board composition, management turnover, regulatory issues, and industry reputation. These signals provide insights into the quality of leadership. If management appears inexperienced, aggressive, misaligned, or opaque, I avoid investing. In banking, management quality is often more important than balance sheets alone. The right leadership can navigate crises, while poor leadership can destroy even strong banks. A clear example comes from a regional bank CEO I met in 2018-2019. While competitors aggressively grew commercial real estate portfolios, he pulled back, citing overvalued assets and loose underwriting standards. Short-term earnings suffered, but long-term safety prevailed. When the commercial real estate crisis emerged, his bank was well-positioned, minimal exposure, excellent credit quality, and thriving while others struggled. Disciplined management and prudent capital decisions made the difference. In conclusion, investors must focus on 3 high-risk categories: banks with concentrated deposit bases, banks heavily dependent on brokered deposits, and banks with weak management and governance. Depositors and shareholders of these banks face the potential for sudden, catastrophic losses. The banking sector is entering a period of extreme stress, and only banks with strong leadership, prudent capital management, and diversified stable deposits are likely to survive. Acting proactively to identify and avoid risky institutions is critical for preserving capital. The banks that survive and thrive through a crisis are those led by disciplined, conservative management. Take, for example, a regional bank whose CEO prioritized prudence over short-term growth. They maintained strong capital cushions, avoided excessive risk, and focused on credit quality. Today, they are gaining market share, acquiring weaker competitors, and benefiting from a conservative strategy that has been completely vindicated. That is the kind of management and the kind of bank you want. Conversely, there are banks whose management raised red flags early on. One Pacific Northwest bank had a CEO who was overly promotional, always talking about growth targets and ambitious expansion plans while glossing over credit quality and interest rate risks. He struck me as a salesman, not a banker. I avoided the stock, and my instincts were correct. When the environment became challenging, the bank had grown too fast. Underwriting standards were compromised, capital cushions were inadequate, and the stock lost 70%. The bank is now at risk of failure. The warning signs were visible to anyone who paid attention to management's communication style. Another signal to watch is insider selling.
Executives or directors selling significant amounts of stock may know more about the bank's problems than they publicly admit. They could be nervous about the future or securing profits before the situation worsens. Large insider selling is not definitive proof of trouble, but combined with other red flags, it is a warning you cannot ignore. The most dangerous banks are those where multiple risk factors overlap. A bank with heavy commercial real estate exposure, concentrated deposits, and weak management is a train wreck waiting to happen. Consider a regional bank with 40% of its loan portfolio in commercial real estate, deposits concentrated among developers
and investors, and an aggressive CEO with only 3 years of experience and no crisis management background. As commercial real estate losses mount, the bank's capital erodes. Depositors, experiencing the same market pressures, quietly withdraw funds. The bank must sell assets to cover withdrawals, realizing losses that deplete capital further. The aggressive CEO avoids raising capital, cutting dividends, or shrinking the balance sheet to preserve appearances, hoping conditions improve. They do not. The weak board goes along, unwilling to force hard decisions. Losses continue, deposits flee, and capital disappears. Eventually, the bank becomes insolvent. Shareholders are wiped out. This is not hypothetical. It is exactly how most bank failures occur. Multiple risk factors compound, and weak management accelerates the decline until recovery is impossible. You may wonder why these risky banks have not failed already. Bank failures develop slowly. Problems accumulate over months or years, management often hides issues, and regulators give banks time to attempt fixes. As long as deposits remain, even troubled banks can limp along. But eventually, a trigger, such as a large loan default, a depositor withdrawal, negative news, or a regulatory exam, sparks a rapid collapse. Once the crisis begins, it moves fast, and banks that were hiding problems suddenly fail. This is why you must exit these banks before the crisis, not during it. Waiting too long can leave you unable to sell, with stock values plummeting or trading halted. Some argue that these banks' stocks are cheap, trading at low price-to-book ratios, and represent bargains. This is a dangerous misconception. Book value assumes assets are worth what is listed on the balance sheet. But in a crisis, loans and securities are often worth far less than their carrying value. Realistic asset valuations can reveal insolvency even when book value appears positive. In 2008, many banks that seemed solvent based on book value went bankrupt once assets were marked to market. Shareholders lost everything. Trying to catch a falling knife in banking is futile. Cheap stock does not mean safety. My guidance is simple. If you own stock in any bank that fits the 3 risk categories, concentrated deposits, commercial real estate exposure, or weak management, sell it immediately. Do not hope for a bounce or wait for a recovery. Assess each bank carefully. Commercial real estate exposure above 20% of loans, concentrated deposits in a single sector, inexperienced or aggressive management, and multiple risk factors are all red flags. If a bank checks multiple boxes, exit immediately. Use proceeds to invest in safer alternatives. Large, diversified banks, JP Morgan, Bank of America, Wells Fargo, may face challenges, but they are unlikely to fail. Alternatively, consider other sectors entirely: technology, healthcare, consumer goods, or even cash and short-term treasuries. Cash at 5% provides return and flexibility to invest in opportunities after the crisis. If you hold failing banks, you will lack the capital to act when good opportunities arise. I have been investing for over 70 years and survived multiple banking crises. There is nothing worse than watching a stock go to zero. Unlike a temporary decline, bank failures eliminate capital. The emotional toll is severe. Regret, frustration, and self-doubt can cloud judgment for years. Do not put yourself in that position. Preserve your capital first. There will be abundant opportunities elsewhere. Protecting your money now means avoiding dangerous banks before the coming crisis wipes them out completely.